So what they're doing is the hedge funds are borrowing money so that they can bet on small changes in the price of these gilts. The challenge is that if you have a crowded trade, that means that with a small number of players, there's a risk that if there is something which makes these players nervous, they all unwind the trade at the same time. And because it's leveraged, the trade is much bigger than they are, and that has a financial stability impact on the gilt market. So we've had this, some of the regular listeners will know this has been a factor for the US Treasury markets for ages. There is a multi-trillion-dollar on and off trade around the US Treasury market basis trade, which has unnerved global regulations, and the BOE has previously warned on that. Their concerns are now closer to home, and I guess the fear is that if there are unpredictable price moves or there are political issues or anything which makes people want to rebalance, that then leads to a potential disorderly unwinding of the trade, and that can impact markets. The challenge is there's not a ton that the Bank of England can do about it. I mean, they can warn about it. They can say, we think hedge funds should adequately manage their risk. I doubt any hedge fund is sitting there thinking, okay, I'm going to engage in some inadequate risk management today. So it really is just a question of calling attention to it, making people conscious of it. They can maybe, another part of the Bank of England can make sure that the banks themselves are being cognizant of the risks which they are allowing hedge funds to take, and making sure that any lending they're doing, that they're managing the lending. But beyond that, it is a case of wait and see. I mean, we've had massive concerns about the US Treasury's basis trade for quite some time, and the basis rate has not come down during that time.
Yeah, but a very interesting warning nonetheless to keep an eye on, as you say, Laura, even if the bank's powers are fairly limited on that. But one of the things the bank has also been publishing some data on is the stress tests of the UK's largest lenders. All 7 of the biggest banks passing the stress tests. What's your reading of the outcome of that?
They did. And do you know how long it's been since a bank last failed the UK stress tests? Quiz for you there, Stephen. Take a guess.
2009?
No, it was actually more recent than that. 2016. But these days, almost nobody fails stress tests. So we are very, I mean, it would have been a big shock if anyone had failed a stress test. But it's pretty much impossible now because banks are so closely monitored. Their capital is monitored on an ongoing basis. But the stress tests is another reassuring sign. It does lead me on to my favourite topic of the day, which is the UK bank capital revamp. So what the Bank of England also announced this morning was that for the first time in a decade, they have changed their view on what the optimum level of capital in the UK banking system is, and they now think it is 1 percentage point lower than it was 10 years ago, and they're going to make some changes in 2027 to operationalise that, or to effectively require banks to hold less capital, and they're consulting on other things as well, which is super interesting because it's against a backdrop of, as you say, there are rising risks around the gilt market trades. They're also concerned about AI, they're concerned about the private market risks, but at the same time they are actually, this is the closest we've come, and they hate this word, this is the closest we've come to deregulation, because what you're talking about is saying we think the bank needs less that banks need less capital than they used to, and that matters.
So this decision, my understanding is this decision could come as soon as next week. Is that right when it comes to the UK bank's capital requirements?
Oh, they actually announced that earlier too. It was just lost among the many pages. Right. So they had an 80-page document. So what they have said they will do so far is they have said, we are going to cut something called Pillar 2A. We're going to do that at the start of 2027 when the next Basel package on global capital comes in. And that is because we recognise banks now need less capital than we thought they needed. What they're still going to do is in the first half of next year, they're having a consultation on various other things which might actually improve the landscape for bank capital. Now, the devil will be in the detail, and shares have moved a bit on this, but not a ton. And I think there was a lot of detail this morning. People aren't really sure what it all means. The other constant tension is banks don't like to live on the edge when it comes to capital. So it's a bit like the monetary policy issue around the transmission mechanism. So it's not obvious that if I cut your requirements by 1 percentage point, you're going to immediately lend that money out or spend it on share buybacks, because there's always a fear about, first of all, how permanent is that cut going to be? Because these things could ebb and flow with how people are feeling about risk. But it tends to take a while for banks to get comfortable with the fact that, okay, the BOE is now happy for them to have less capital and they can actually mobilise that. But it'll be so interesting to watch, for me anyway. Maybe not for Stephen or for you, Tom.